Hello, everybody. Welcome to this webinar on understanding the IRS Form 990. My name is Christina Balboa, and I'm the director of the Center for Nonprofit Strategy and Management at Baruch College, City University of New York. I want to thank our funders, Con Ed, for their generous donation making this possible, especially the Office of Strategic Partnerships. Thank you so much. And I want to thank our speaker today, Larry Scott, who has been for years kind of a cornerstone of this event of Consulting Day. Consulting Day is a tradition that is now, I believe, 19 years old at the Center for Nonprofit Strategy and Management, where we offer free 45-minute consultings to nonprofits from around the region. And as we've gone virtual these past 2 years, it's expanded across the globe, actually. So as part of that, we also offer a few workshops within Consulting Days. We had on Monday a large event with on fundraising and how fundraising is pivoting this year and will be for this foreseeable future. And Larry Scott is kind of our regular what clients are looking for when trying to demystify the 990. So I want to thank you so much for spending your time with us, Larry, and I will give you the floor. And I'll also say, if you have questions, we ask that you ask them out loud. But if you want to use the chat, I will be monitoring the chat for any questions. So thank you, Larry.
Oh, you're welcome. I don't know if my video is on, is it? Okay. Well, good afternoon, everybody. I'm assuming it's afternoon for everybody around the country. My name's Lawrence Scott, but most people call me Larry. I'm known as Larry. I will share my screen with you. And I believe everybody signed up just as a reaffirmation to this seminar called Understanding the IRS Form 990. And I'll be your speaker, and I will take you on this little journey for 2 hours. Some of you know me, especially if you're in the metro region of the New York, but very quickly, I'll just give you kind of a quick synopsis of my background. I've been an accountant for, I don't even want to remember for how long, but over 40 years. I am the co-founder, co-managing partner of a boutique CPA firm located in Manhattan near Penn Station that basically services only not-for-profits. We're up to handling over 650 not-for-profit organizations of pretty much every type. With maybe the exception of with the exception of hospitals, and we don't handle any universities. And with that, we do over 650 990 type returns, 990, 990 EZ, 990N. In addition, as Christina said, I've been teaching at Baruch, but also at a number of other colleges over the years. I've also been an instructor at colleges teaching undergraduate and graduate, but I much rather talk about not-for-profit rules, which I'm more interested in. I've also been a panelist. Why I have also a different perspective on not-for-profits, in addition to servicing them, I've been on boards, I've been president, treasurer, board member. So I know what it's like to be on a board, and I know what it's like to manage a not-for-profit from a board point of view. Lastly, as many of you know, there's a shortage of training in not-for-profit financial management, accounting, and reporting, such as the 990. There's a shortage of classes and instruction. So I've created many years ago a number of training courses, which I've given through colleges. In the past, NYU School of Continuing Professional Studies, for a number of years at Baruch. After that, Fordham for a year, and now I'm doing it through Manhattan College. Okay, enough about me. Let's go right into the heart of the 990. I can make this statement, and I think it's pretty accurate, that the Form 990 is probably one of the most transparent, if not the most transparent form filed with the IRS. One of the major reasons it's open to the public, with some very few exceptions. and it discloses a lot more information just than financial information, like most tax returns. And although many people refer to the 990 as the not-for-profit tax return, not-for-profits don't generally pay taxes. Therefore, I just like to refer to it as the information return or return, because there really is no taxes due. Now, in addition to a regular tax return being given to the banker or to a vendor, the 990s are given and read by a vast number of people who are interested in what a particular organization does. The readers in the 990 include a lot of groups such as, and many of you that are on this seminar that are attending go into the first category of regulatory agencies. And there are many. Many of you belong to the AG or Department say Department of Labor, the AG office, but the IRS looks at the 990. Many state agencies other than the AG look at the 990. Granting agencies, and there are literally thousands, maybe tens of thousands of granting state, federal, and city and sub-granting organizations where block grants go down, that people working for these agencies look at the 990 to get an understanding about the organization's operations. In addition to the regulatory agencies and the government and state granting agencies, you have foundations, corporations, and individual donors. Why would they look at this? Well, foundations, corporations, and I'll say wealthier donors, not the ones giving $50, but ones that are giving tens of thousands of dollars. Before they give money to a not-for-profit, public charity, or another type of not-for-profit, they want to make sure that they're giving their money to a worthwhile organization. So they will look at the 990s to glean how the organization is operating. And then you have other groups such as bankers or lenders or even vendors that sell on credit that want to look at the 990 and say, and before they give money on credit or they loan money, they want to make sure that the organization again is reporting what they should be reporting and how well they're doing. And then you get another group, which maybe not directly related, but you have a lot of researchers and analysts and members of educational institutions such as instructors that also look at the 990. I've received calls from around the world from instructors that are teaching this area, and apparently there is a shortage of training material in other countries, asking me questions about the reporting here. So you have these people also looking at the 990. Now, obviously, anytime you do any type of reporting, you want to be accurate. But with so many people looking at the 990, accuracy here is as important as anywhere, if not more important. And it's needed to ensure that the organization is complying with a whole host of things, such as federal and state laws, rules, regulations. And because a not-for-profit has a special place in the tax code, accuracy is important to make sure that the grants and contributions that are given to the organization are properly being used. And this basically falls under protecting the public and ensuring that the public's being protected from the special status that the not-for-profit has. Now let's go a little deeper here to start talking about some of the rules. And this sometimes is not known, and it's not known by startup not-for-profits, that every not-for-profit that incorporates, and I can't speak for every state, so for you guys at various states that might have some separate rules, please excuse me if I make a statement that might be general for a lot of states, but not all states, and I'll try to preface that. But according to the IRS, you must file a 990 or a 990 series, which we'll mention quickly a little later, even if you did not receive your exemption. For example, the IRS has a application called a 1023 or a 1024, a 1023 if you're a public charity, or foundation, a 1024 if you're another type of not-for-profit. And once you get exempted, let me back up. Once you are incorporated, you must file a 990, 990EZ, or 990N. That's one of the 990 series, even if the IRS didn't give you exemption. And the IRS has a 27-month period to give you that exemption. So, and sometimes it's a good idea not to file for exemption right away because you need to support why you want to be a not-for-profit. So it's a good idea sometimes to wait, but the IRS says you must file. This trips up a lot of organizations. I can't tell you how many times every single year I find out from an organization that comes to me or my firm that says, oh, we started 2 years ago, but now we reached the threshold, we have to file. And I would say, did you file last year or the year before? No, because we had very little income. Well, that's a misconception. On the 990, you will see, and hopefully my pointer works, on the bottom of the left side of the, I should say, bottom of a column B on the left side of the 990, there's a box, and you check off application pending, meaning application for being a tax exempt organization. But again, you have to file as soon as you incorporate. I have some statistics that I think you'll find really interesting. Now, I've been doing this for 30 years, so I've seen the changes. I'm going to make a statement I think I've gotten out off of the IRS statistics. But basically, I think within 40 years, the number of not-for-profits in the United States has doubled. When I started, it was somewhere shy of a million. According to the IRS data book, and the most recent one that's come out is 2019. I did not see the 2020 yet. The total number of filed returns in the 990 series, that would be the 990, the 990EZ, which is an easier form if you're smaller, the 990N, which is for very small not-for-profits, 990PF, which is the private foundation return, and the 990T, which is for unincorporated activities, I should say unrelated business activities, sorry. All of these returns put together, there's over 1.5 million. Now, what's interesting is not every not-for-profit is listed here because some are exempt from reporting. These are typically religious organizations. So they could apply and they're exempted. And the IRS and some people I've spoken to at some of the departments have estimated there might be, and there's no way to corroborate this, there might be another 500,000 exempt organizations out there that fall under the religious banner, religious umbrella. And so that would make the total number of all of these close to 2 million. And it's growing exponentially every year. Close to 100,000 not-for-profits apply for tax exemption each year, if my memory serves me correctly. Now look at this other statistic. With all these numbers, there are certain states that have a high number of exempt organizations. Many people that I've spoken to assume New York has the highest number of not-for-profits, but as you can see from the statistics, that's not true. Actually, California does, with upwards almost 200,000, right now at 172,000 plus. If you take these five states alone constitute over a third of all the states holding not-for-profit organizations or not-for-profits working in that state. California, I said, is the highest. Ohio comes next, shy of 100,000. Texas, shy of 100,000. New York, shy of 100,000. Florida, a little bit less. So it'll give you an idea of alone right here. What is that? 1, 2, 3, 4, 600,000. It's, like I said, over a third. I'm going to get into the thresholds and the due dates. Very, very important, especially for organizations starting out that don't know the rules. And 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 I could say this with certainty, like any other type of endeavor, when people start doing that endeavor, they learn the rules as they go along, sometimes to a bad end. But the reporting is one of those rules that could really trip you up. Let's talk about the 501c3. Now, that's an IRS designation for public charities, also for private foundations. But talking about this area, this group, and I'll leave out the private foundations right now, just talking about the public charities. And you must file a the annual return is one of these three, and a fourth one if it applies. Working backwards, if you are what's considered a large, if you want to call it that, somewhat a not-for-profit with $200,000 or more in gross receipts, and over half a million or more of total assets, you must file the full 990, which is the larger return. They created an easy return a number of years ago, which said if you're a smaller not-for-profit, under the 200,000, but basically over 50,000, and your total assets are under half a million, you can file this easier 990 easy, which is only 4 pages, as opposed to the 12 without any additions. So that's obviously a much easier return to do. Then a number of years ago, not that many years ago, the IRS created a really easy form called the 990N, known as the electronic postcard. This is for organizations that have annual gross receipts of 50,000 or less. And the reason for creating this, for a little history, up to the time that I think it was 2007, if my memory serves me correctly. Before this, the IRS didn't have a clue how many organizations were out there. If you were so small, you didn't know, or you didn't follow the rules, and you weren't filing any returns, or they were too difficult, or you didn't have the money, so you weren't filing, you being a small organization. And the IRS just had no idea, and other regulatory bodies had no idea how many not-for-profits were out there. So they said, now that we have the technology on computers and the internet, let's create this very, very simple form that has, I think, like 8 different fields that have to be filled in. And it could be, as a matter of fact, not just can it be done electronically, but it can only be done electronically. And every organization is now required to file either the N, the Easy, or the 990. I'll just mention briefly, the 990T has to do with activities that a not-for-profit does that's not related to their exempt function. And if they basically are earning $1,000 or more, they must file this 990T. This seminar does not have enough time to go into that, so we won't be really delving into the 990T at all. But I just wanted to mention it here. Now, the due dates. The due dates for the IRS are basically, it's 1 month more than any of the other due dates. For many corporate entities, it's 2.5 months for filing your corporate return. For individuals, we all know that infamous April 15th date, which is 3.5 months. The not-for-profits are given an extra month, and it's 4.5 months after their operating year. So if you are on a calendar year ending 12/31, the due date would be May 15th of the next year. By the way, bear in mind, if the date falls on a holiday or a weekend, it's the next work day. So it might not exactly be the 15th or on any of these. If you are on a fiscal year, and you can have any fiscal year, meaning your year goes from 1 month to another month different than the calendar, many organizations have a June 30th year end. Then again, it's still 4.5 months after the year, which if you're on a June 30th means your return is due November 15th of the same year. Now, there used to be 2 exemption forms you have to file. And I said used to. And one was an automatic, and then you had to request a second. And the kind of the, I don't want to say the joke of it, but you're supposed to request a second, but basically the IRS accepted anytime you wanted to ask for a second request. So what was the whole point of doing a second request? They changed the rule and said, now we'll make it 1 6-month extension. It's on Form 8868. So the form gives you another 4.5 months after the operating year. So you get a total, a total of 10.5 months that you have to report your operations. So just to give an example, if you're a calendar year on 12/31, it would be due that same year, November 15th November 15th of the subsequent year, not the same year. If you are a June 30th, which would put you into the November is the original due date. Now you go into the subsequent year, May 15th. Your return has to be filed by then.
Larry, we have a few questions from the chat that I wanted to make you know
Okay.
about. The first one is, if the revenue goes up and down, can you switch from 990 to 990 EZ or N and then go back to 990 if revenue increases?
The answer to that question, and I'm assuming you're talking about from year to year, not within the year. And if it is from year to year, you can change from year to year. You're not locked in. If you file a 990 in year 1 and your revenue goes down in year 2, you can file a 990 EZ or a 990N in year 2. If somebody is asking whether it goes up and down within the year, no, it's the total for the year.
Excellent. Okay. And then the second question from the chat is, just to be sure, all nonprofit corps must file 990 regardless if no donations were received. What if the organization uses a fiscal agent?
Oh, that is a really good question. And I'm not sure I want to take a lot of time to answer it, but it's a very good question. Using a fiscal agent brings in a whole slew of criteria or elements that are very confusing. There isn't a couple of months that go by that I don't have to explain this to people, but I'll try to quickly answer this. And then whoever asked that question, if they want to follow up with a longer question after this, and I get that through an email, I'll answer you privately. But basically, the question of a fiscal sponsor is, if the fiscal sponsor is getting money for the organization and also paying for their bills, that's fine. Where the problem comes up, where a lot of organizations, they don't realize, is if a fiscal sponsor gets the money and then gives it to the not-for-profit, the not-for-profit picks that up as a donation, basically from the fiscal sponsor. The reason for using a fiscal sponsor is that you did not get your tax exemption yet, and therefore the donor can't get a tax-deductible contribution. So you need a fiscal sponsor until you get your exemption. But remember, you have to file your 990 regardless of whether you get the exemption. The question is, did you get money in a bank account with your name? If the money came into you, you being the not-for-profit, then it must be accounted for by you regardless of whether it first went to the fiscal sponsor, then you, or directly from a donor. So I'm going to leave it at that. But that's about the quickest way I can answer that question. Okay, somebody I think asked this question earlier, not before the course began, about electronically filing return. So I'm going to answer that. Very recently, in 2019, in one of the tax rules that got passed by Congress, it requires exempt organization to now file electronically. So the information returns, again, I call them information returns, not tax returns. Technically, they fall under the Tax Act, but information returns and related forms beginning after July 1st, 19, that's for years beginning after, which basically means unless you have a fiscal year that starts in August or September, for most organizations on a calendar year, will be 2020, you must file electronically. Now, here's the big kind of axe that comes down on a lot of organizations that don't know the rules or are not following the rules. If your gross receipts, and I'm going to define later what gross receipts mean because they're interpreted by different people differently. The IRS actually changed its threshold and made it, I believe, following cost of living, because for the longest cost of living adjustment, for the longest time, it was a fixed amount, and basically 2 years ago is now being adjusted. So I'm assuming it's a cost of living adjustment. If your gross receipts are under $1,084,000, it used to be 1 million for years and years and years, but now it's 1,084,000. If your gross receipts are under 1,084,000 and you file after the due date, and I include extensions here. So if you file a properly filed extension, that is the due date gets extended. If you file after that and you don't provide reasonable cause, and I will talk about that later, you are hit with a $20 a day penalty plus interest. The maximum is $10,500 or 5% of the organization's gross receipts, whichever is less. And as I'm going to show you later, for a small organization, for a very small one, this penalty is very burdensome. But first, let's look at the ones that are over 1,084,000. Again, used to be 1 million. If you file after the due date and with extensions, it goes from $20 a day to $105 a day plus interest, or a maximum of $54,000. So let's bring it home with an example. Let's say you're on a calendar year. Your year ends on X1. Your due date would be May 15th, or if it falls on a holiday, of the next workday of the following year. If you file no extension, in my example, you filed on August 15th of the next year, and you didn't file an extension, you are now 3 months late, 90 days. If you are a small organization, what's considered for their penalty, small organization, you have to pay $1,008,000. I'm sorry, not $1,008,000. That would be really burdensome. $1,800 if you're under that threshold, plus interest. If you're over, no, I was correct. Sorry, long day. If you're over 1,084,000, you have the penalty would be 9,450 plus interest. Just the example I gave with filing 3 months late with no extension. Now let's talk about what happens when you file an extension, but you don't submit it in time. This happens a number of times. So you filed your extension, getting you on this form is 8868. It gets you to, in this example, it would have been due May 15th of the next year. You filed the extension, you get all the way to November 15th of the next year, but you didn't file it in time. You didn't file it for another couple of months. May 15th of the next year. Now you're 8 months late, 240 days. What happens is your extension gets disallowed as if you never filed it. So you're not in this example 2 months late, as many organizations think, oh, I know I had to do it with the extension and I missed it. You're now going all the way back to the initial due date. If you're smaller under the threshold, the 1,084,000, you now owe $4,800 for the example I gave, or if you're a larger one, $25,200 plus interest. Now, some organizations are consistent and not in a good way. And the next year, they do the same thing, and the IRS has been backlogged, and they get hit with 2 years penalties. It is extremely, extremely hurtful and quite a burden financially on the organization. Now, the IRS put in a rule that said and this was with the revised form that came out in 2008, that if you don't, it might have been 2007 or 8, if you do not file a return for 3 years, you are automatically revoked. Your exemption is automatically revoked. This happened when they put the rule in the first year. So many organizations weren't filing year after year after year. And that first year, which I believe was 2011, for some reason I recall that 10, 9, 8. Those were 3 years. They lost their exemption, and the number that lost their exemption was astronomical, literally in the hundreds of thousands. And they had to apply for either restatement or apply for exemption from scratch. Now, the IRS does allow, as I said in the beginning of the slide, if you can provide reasonable cause for late filing, they will abate the penalty, meaning they will let you not pay the penalty. I have seen a lot of people put explanations of why they filed late, which are absurd. Long explanations. So and so was sick, and this. That's not an excuse. There has to be a tangible, at least to the IRS, why you didn't file and do your fiduciary duty of filing on time. One of the reasons, and it shouldn't be used arbitrarily or fictitiously, but many organizations rely on professionals to prepare these returns. Unfortunately, many professionals, or say they're professionals, really don't do these type of returns often, or do many of them, and they don't always know the rules, or they don't get the information from the organization. But if they are doing it, if the organization does have a professional they're relying on, and the professional is negligent because it's tax season and the accountant is so busy doing other returns and it falls by the wayside, then the organization can explain why they filed late by relying on a professional. In my experience, this explanation has been accepted most of the time. However, if this is done year after year, the IRS keeps some record of this. It's not going to be allowed a second year. One of the things that someone could do, someone being the organization, if for whatever reason they can't file on time, and I guess a good example right now would be the pandemic, where so many offices are closed and people can't get their records. If you really can't get the return done in time, even with an extension, what I suggest to do, and I want to say this carefully so it's not misconstrued, I suggest filing an initial return before the due date using information that you have available as accurate as your information is at that point. And I'm prefacing this by saying you must use information that is available or somewhat accurate. I'm not suggesting you prepare a fictitious return, put numbers down on it just to get it in time, because this is out and out negligence. And if you're found out to be doing this through an audit or any other means, it's going to be you're going to be cited for this as for negligence. So using your unadjusted numbers or the best numbers you could put together, prepare an initial return, and then once you have additional information, file an amended return. And again, I don't suggest doing this year in and year out, but if you do have this situation, it's unusual, you can do that, and thereby avoid a problem. Okay, let's jump right into the 990 now. And what I'm going to do, guys and gals, and everybody that's listening, I am going to not just talk about the rules, but I'm going to mention some tips or suggestions for avoiding problems, and also things that could cause issues with reporting. I think a number of you have also asked in your questions when you signed up if I can do this, but this is what I usually do in most of my seminars anyway. So you can actually take away from this some concrete suggestions for either preparing the return or what to look at when you're reviewing a return. So the 990, which I will be covering. Unfortunately, we don't have time for the 990EZ, the 990N, or even the 990PF or the 990T. The 990 has 12 pages. This came about in the revision in 2008. And I should mention here, the IRS put together a task force of a number of knowledgeable people and working with the IRS. And the project, if my memory serves me correctly, went on for 5 years to revise the 990. Now it's not a new form; it's been around for 12 years. But this 12 pages with also the schedules was the revision. I had the pleasure back in 2009 giving a seminar on these revisions with the manager at the IRS who was in charge of the revision, Stephen Clark. And that was very illuminating to me, because when people were mentioning questions about the change in the form, I was able to turn to him and say, you explain why the IRS is doing this if my explanation is not good enough. So it was a very productive half-day seminar given at NYU School of Continuing Professional Studies. Okay, so there are 12 pages of the form, and the IRS created 16 schedules that might be needed. When I say might be, not all of them, but if something's applicable and you meet the tests for reporting certain types of activities, you would then have to file one of these 16 schedules. It goes from A to R, and a smart person looking at the letters, and even not a smart person looking at it, just scanning down it, might notice there are two missing. No P and Q. And I have to mention this because I get asked periodically why there's no P and Q. And I did have the ability to turn to Stephen and ask him why there was no P and Q, and I could not get an answer from him. So I'm not sure. If I had to guess, maybe there was two other schedules that were originally thought to be issued and then decided not to be issued. But other than that, I couldn't tell you. I want to mention one thing before I go to the next slide. One of the schedules, it's not really a schedule. Schedule O, it's not really a schedule where you put numbers. It's more like a notepad, a blank notepad, which basically gave space for putting information and reporting information that does not appear any other place on Form 990. It was a catch-all type of form, and could be, the number of pages of Schedule O could be quite extensive. Let's talk about some general points here. What is the IRS looking for as a general point, as a general concern? And it's not a secret. The IRS is the agency that is empowered and given the authority to give tax exemption to an entity, and it's quite a benefit. And the example I always like to give is you have two organizations. One's a hospital that's a for-profit, and one's a hospital that's a not-for-profit. And they do exactly the same thing, except the not-for-profit might do research and education, which justified it being an exempt. But both are basically servicing patients, and both are basically doing the same types of medical services. The hospital that's a for-profit ends up with $1 million in net income, pays taxes, federal, state, and maybe local. The not-for-profit does not pay income taxes. So it's quite a benefit to be exempt, even when you're doing an activity that a for-profit might do. So for that privilege, the IRS wants to make sure that you're doing what you're supposed to do for why you got your tax exemption, and they want to protect the public who has a, there's a second benefit to a not-for-profit, that they can get donations that the donor can deduct on their taxes. It's a tax deductible distribution and payment. And so that's another benefit. And so to protect the public, the IRS wants to make sure the not-for-profit is doing what it's supposed to. And the 990 is the primary way that it ensures this. So the 990 and the schedules are basically designed to determine that nothing unlawful or unacceptable is going on. Now, obviously, people don't want to put down that they're doing something illegal or unacceptable, but there are a lot of questions on the 990. And if things don't meet up or during an audit, whether it's an independent financial audit or a regulatory audit, if it comes out, there's going to be sanctions. So the IRS wants to make sure the organization is complying with its exempt mandate, what its activities, why it said it's exempt. Are they doing what they're supposed to be doing? Or are they really doing a for-profit activity? Is compensation reasonable for what it's paying its officers and employees? And are the employees being protected? So it asks for a lot of detailed salary information. And by the way, when I first gave this seminar back in 2009, somebody raised their hand and was on the board, and I remember this clearly, and said, I don't want to disclose my salary. That's private. And I had the benefit of turning to Stephen and saying, you feel free to tell him what he's going to. Oh, and he went further. He said, and I don't want to do that. And I said, that's the rules, because on a private tax return, you don't necessarily put down your salary. And I said, Stephen, you can answer the what happens if you don't want to do this, and basically said, if we find out you're not doing it, you might lose your exemption. So the IRS requires a compensation for certain recipients of money have to report. Are they meeting the public support test? We'll talk about that in a minute. If you're a public charity, you're saying I'm a public charity because I'm basically raising my money from the public. They are a test to see if most of your income is coming from the public. The IRS wants to also make sure, and the return is also trying to disclose this, that there's not something called a quid pro quo type of transaction or activities going on. That somebody is not giving something and getting something back. And that's the reason why one of the reasons why they ask for information about large donors, that people that are donating a lot of money aren't also a vendor or benefiting from the organization, in which case something might not be fair exchange, a fair arm's length type of an agreement. They also want to make sure that the organization's not involved political campaigns. That's for most not-for-profits, definitely 501c3 public charities, and many of the others, they can't be involved. It also wants to make sure that the lobbying activities, which by the way is allowed for a public charity, but it must be minimal. And if you want to do more than minimal, you have to apply to the IRS to be able to have more than minimal activities when it comes to lobbying. That's again for a public charity, a 501c3. Other types of exempt organizations like civic organizations, code section 501c4, are allowed to do a little bit more lobbying than minimal. The other thing is, I used the hospital as an example. Public charities cannot operate basically their primary purpose being unrelated to their mission. They started off doing this, but they were gonna put on educational seminars, but they basically opened a store, and the store is selling something unrelated, and they are making most of their money from that. If that's the case, it's an unrelated business income activity, and it's subjected to unrelated business income tax. The IRS is looking for that. As a matter of fact, it's looking for that in any, and I know I'll say every audit I've been involved with the IRS and most regulatory bodies, the agent, the auditor is looking to see if there unrelated business income tax. And if there is, did you file a unrelated business tax return, an I-90T? Now,
We
that's what
have
the
another question,
Sure,
Larry.
sure.
So in the chat, someone asked, how does IRS treat a return where answers required to be reported on a particular schedule are pushed to the end of the return as miscellaneous statements? Is this acceptable per professional preparer standards or IRS regs?
I would have to get more information about that question. If if I understand it correctly, and you're saying that you don't fill out one of the sections properly, you don't check off, because most of them are boxes. There is disclosures throughout the whole return, and you decided to kick that answer down to the Schedule O at the end, then you're not filling out the form properly. When the form says provide information about bonuses to the executive director and other compensation, and you don't fill it out on the form, and you try to squeeze it in saying I'll I won't make it that obvious, but I'll comply by burying it in here, you're not complying. So my answer to that, if I understand the question, is that if you're supposed to disclose something within the body of the 990, you must disclose that information in the body. You cannot be cute, for lack of a better term, and not do it properly and then do it in Schedule O and say I complied and I buried it. And I kind of understand why you might want to do that, to maybe not highlight something that you're doing wrong or not doing correctly, but you can't do that. Any other
Great.
questions?
Thank you.
Okay.
No, and that person also says, thank you. You understood the question properly.
Okay.
Excellent.
So that's the IRS key concerns. Here is what my perspective of problems with the organization, or what the organization should be concerned about. And I'll raise it. And I mention it to most of my clients if they're not doing this. Most, or many, I can't give you a statistic, but many boards, members of the board as a not-for-profit, are not financially savvied or knowledgeable. They might be a financial type person. They might be a real estate person that works with numbers. They might be an attorney that works with numbers. They might even be an accountant, but they don't know the 990 rules, and they don't understand. And some of them could be kind of confusing. And the problem is, when they don't know this, they don't delve into wanting to know it. And I'm mentioning this as a point about reviewing the 990, because prior to submitting the 990 to the IRS and any state regulatory agency, the board or a committee of the board should be reviewing the 990. And what I find very interesting after doing this 30 plus years is the questions that I get from board members or from the organization about the 990. So what I mean is, if a draft is prepared on the 990 and submitted to a board or board committee, so many times those members don't delve into it and say, I want to understand where this number comes from for the number of donors that gave over a threshold, or something very, very kind of zoomed in with the numbers and the reporting. What I find is the biggest concern, and I say biggest only because it's the most number of questions raised in that same area, are things that are really not that important for reporting, but where a person who's not familiar with the rules could wrap their hands around, and they can understand it. And I think it's kind of funny in a way, because this is what people understand, but it's not really good to as far as a review prior to submitting. So if I had to say what is the biggest question or questions in one category asked on hundreds and hundreds of returns that me or my firm has submitted, um, one of the ones that are you misspelt the board member's name wrong. And I understand that, board members giving their time, and that you're very appreciative and you don't want to offend anybody. But as far reporting purposes, I got to tell you, the IRS really doesn't care if you spelled Aaron with 2 A's or 1 A. But that is something that board members know right away and understand, and comes up. The next question that seems to be asked most frequently is the program descriptions, which is required on the form on page 2. People reading it going, that's not exactly correct. We changed this program around. And and it is important to disclose your programs properly, but it's not a promotional piece. And many organizations use the 990 in addition to reporting and its reporting obligation, also as a promotion piece. So they want the description of the activities to be very, very specific and quite long. And again, that's not what the the 990 for the IRS purposes are. It's just to give a feel, a summary of what your activities. But that is one of the questions asked very frequently. Another issue that I find comes up is not asking why a box is checked properly, why it's yes or no. Many of the boxes on the form have a yes or no. Unfortunately, as I'm going to mention soon, it does not have a does not apply box. And there are a couple of boxes, lines where the does not apply applies, meaning that it's not a yes or no. And by leaving it blank, people think something is wrong. So that's unfortunate. There should have been a third box squeezed in somewhere. Okay, let me start moving in on the 990. Let's go to page 1 at the top of it. This section B has some important information. But besides its name and address, there's some boxes that need to be checked off. Many times organizations will change their name after starting up and find out the name's not really appropriate or accurate to what it does, and it wants a name change. You cannot electronically file your 990 if you have a name change. At least you can't do it if you just change your name and this is the first time you're notifying the IRS. You must mail in the 990 with a copy of your amended certificate of incorporation to the IRS. Now, there is a way to mail this in to them during the year, and if you give enough time and you do mail it in to them and explain that you have a name change, and you give enough time, you can still file this electronically. But a lot of software still won't let you if you check off this box. But the IRS says that if you change your name, you have to mail in. Another box says, is this your initial return or is this a final return? Which means it's not a full year. You have to check that box off. And you have to put in the period beginning and ending for the first or ending year. I give you an example here. If you're changing years, it's important to mention this, and it's not your first year or your final year. When I say changing years, it's going to be a short year. And if you're changing from a calendar year, January, December, to a fiscal year ending, which would be July to June, you cannot e-file. You must mail in your return. And as I said, to repeat, under the current rules, the IRS wants all organizations to e-file unless there is an exemption or reason not to file according to the rules. All right, I'm going to bring home that point I mentioned before. Still on page 1 on the top, they want you to briefly describe the organization's mission and significant activities. That's a pretty loaded question to give you only 1.5 lines. Now, as I'm going to mention shortly, page 1 is a summary. It's a very good summary. Going back to the form, I should have had a whole page I could have showed you, but page 1 is a nice summary of your operations, and they want to get you to get across, you being the organization, a general statement of what your mission is and activity. Obviously, you can't do it in a line and a half, and I get a lot of questions that say you're missing information, and I love to ask, where are you going to put the rest of it on that first page? Um, but many people have a good point. There should be, and unfortunately there isn't, right at the end, maybe in very small font, there should be parenthetically continued, either dash or so the reader knows that the description is continued. Instead of doing it on that line, if you go to the bottom of the page, I pulled it out. If you go to the bottom of page 1, it says, see Schedule O for organization's mission, statement, continuation. But most people don't read this, and it gets kind of lost. Moving down on page 1, I said this is a summary. I think this is one of the best changes the IRS came up with when they revised the form back in 2008. They came up with what I call a snapshot of the organization's basically revenue and expense, and also its assets and liabilities. Just a snapshot. And something that I think is excellent, which is not just a year, but 2 years. With 2 years, you can get a very, very good idea about the organization. So they had a column for prior year, a column for the current year, and they break this down to only a couple of lines of revenue, contributions and grants being a very big part of most public charities' of receipts, program service revenue, investment, and then everything else. And the expenses are also only a couple of lines: grants given out, benefits paid to members if you have members, salaries, which are usually a very big component of your expenses, fundraising fees, and basically all other expenses. And then look at assets and liabilities, just totals. But from this, you get a really good feel how big the organization is, and where their money is coming from, and what their financial position is. By the way, these numbers, if you're using software, it will be populated from numbers you put in more details on other pages of the 990. If you do it manually, which some organizations are still doing against the IRS rules, and they're doing this because a board member is preparing it, and they don't want to pay somebody, or they can't afford to pay somebody, there's a problem, because the numbers on the detail page on the other pages don't jive with the summary here. And the IRS very easily, when they enter this stuff at the agency, will kick out a report saying the numbers don't tie. So that's a problem. Moving down on page 1, you have the signature block. I only want to mention one thing here, or two things. One, per the instructions, the rules, it must be signed by a legal officer. As I said, I'm going to talk about issues, errors, omissions, or helpful tips wherever I can. Here I'm going to kind of jump into a couple of them. One, many times the signer of this form, the 990, is the executive director. And in many states, the executive director is not a legal officer, and therefore should not be signing the form, because under the state law, they are not a legal officer. Many times they do. And all I could say is I haven't seen pushback from the IRS. I will leave it up to the states to decide whether they accept that. But it just seems to be something that's been allowed. A way around this, of course, is to have the executive director have a dual title, both be executive director and be a legal officer, in which case they are now legally allowed to. But again, they sign it. That's one issue that comes up with the signing of the form. Another issue that comes up, I find periodically, is that there's been turnover with the board. Sometimes the prior board or prior board members were doing things that they shouldn't be, or the organization was doing things they shouldn't be. They did a revamping, they have new members, they're cleaning everything up. And now the return is being filed after the original board members are on the board. There are new board members, and the new board members or the new officers don't want to sign the form, don't want to take responsibility for numbers that existed prior to their tenure. And it's a legitimate concern. If they know that things were done incorrectly, improperly, illegally in the past. However, if you are on the board and if you are an officer, and again, this is a state rule, so I'm not going to say it's global, but I will say many, if not most states follow this. If you sign on and you're an officer, you're now legally obligated and responsible for the operations of the organization, and you cannot step back and say, I don't want to sign this, or no one wants to sign this because it was before our time. And that's why you should do your due diligence. You being the board member should do your due diligence, not just said, oh, this is a great organization, I want to join the board, I like what you do, and I want to participate in this. You should do your due diligence and make sure that before you join the board, that you're not accepting responsibility for things that you would normally accept. Okay, let's go to page 2. And talk about what I said, your service accomplishments. On the top of the page, it repeats again your mission. Again, instead of 1.5 lines, you now have 3 lines. Again, it's not enough room to put everything about your mission, but it will kind of hunt over and roll over to Schedule O. As you move down the page, the form and the rules are that you must report on and describe your 3 largest program services and their accomplishments. I'm going to tell you that most organizations don't have a problem of describing their 3 programs. Some of them have a problem of reducing their number of activities to 3 discrete programs, but with a little guidance, they can do that. So they must report their 3 major programs. And here's the key thing. According to the IRS rules, you must also talk about your accomplishments. And I could say a large number of organizations don't do that. If you're providing a program, an example I gave here is 55 people attended this camp in 2020. That's talking about your accomplishments. Many times it's just left out because information is not available or no one realizes that you have to do that. If you are a public charity, a 501c4, or a civic organization, public charity, 501c3, or a civic organization, a 501c4, you must also include here, well, one, you have to include your expenses. So that every organization has to do. But what you have to do if you're one of these 2 organizations is, in addition to your expenses that every organization has to put, this is specific to the 501c3 and C4. You must also include grants that were, and I'm going to say this slowly, grants that were given out. When I or my firm take over a 990 from a prior preparer, I can't tell you how many times that the grants entered here are grants that came in. No, the IRS wants to know grants that you paid out. That's part of your mission. If you're a not-for-profit sponsoring other activities, how much of your expenses went out in grants? So that is different and not always done correctly. If you have programs, you also, and this is excluding donations, but if you put on a program, if you're a museum and and people pay to enter, or if you have a camp or tuition, your school pays tuition, you must put down the revenue that's earned directly related to that activity. Now let's go to page 3 and 4. Page 3 and 4 are basically checklist of required schedules. The IRS put these 2 pages in and put all these questions because in the past, many of these type of questions were never answered and information wasn't provided to the IRS. And if you read the instructions, you might know that you had to provide this on a separate attachment. But the IRS decided we want to come up with 38 questions on these 2 pages, which delineate and determine which schedules you must complete and which and possibly what additional information you must also do within these schedules. It's based on 2 things. The IRS didn't make every organization do this. As in many of the sections, they use thresholds to determine what information you should report. So basically, if you're doing fundraising, but it's only a small event, you might be excluded from doing one of the schedules. So they use either activities or thresholds to determine which schedules have to be completed. These I could try to drill down, but I don't know if it's necessary. On the right, there's really 2 columns, yes or no. I would love them to squeeze in another column that says NA, but it doesn't apply to most of the questions because the rules say you either check off yes or no, or if it doesn't apply, you should leave it blank. It's the blank that causes the problem with people that don't look at the rules, nor do they want to look at the rules. And the idea of this checklist is to reduce incomplete returns submitted or reduce the number of notices the IRS sends out or reduce the number of penalties assessed by the IRS. Um, here's here's a point that I love to tell people when they say, you know what, we don't have a complicated organization. I'm pretty good at doing reporting. I'll do the 990 and save money. The problem is on many of the questions on the 990, they are specific or unique to this type of organization. And some of the terms mean different things for a not-for-profit than they do for an exempt organization. Therefore, in order to know what you're supposed to do exactly, the only way to really prepare this form is to sit with the form, sit with the instructions. Part of the instructions sit with a glossary, which defines some of the terms. What do you mean by a legal officer? Especially for different parts of the form. Some of the parts of the form, an officer is treated differently than other officers. So you need the instructions, the glossary, and their appendices also. So you should be looking at the different appendices to determine what you should be putting in or filling into the form. Now, I already said the yes or no thing. The problem is here, no one, at least if you're sane, are going to sit with the instructions and do all this and prepare the return. So you might look up something, and that's where you get tripped up if you don't prepare a lot of these returns. And this applies to accountants too. Accountants that are or CPAs that prepare a lot of tax returns. They might prepare a lot of individual and corporate tax returns, but if they don't prepare a number of these forms, they might not know what the specific rules are and might misinterpret or not fill something in correctly. So we're up to we had page 1, page 2, page 1 at summary, page 2 that was about your programs, page 3 and 4 checklists that told you what parts of the form to fill out. Now you're going up to page, basically going to 5 after your forms. And what 5 does is it talks about other things that the not-for-profit must do to comply with the rules, other types of filing, not related to the 990, but it's a way to ensure that the not-for-profit is complying with its reporting rules. It wants to put important tax compliance information that the organization must file and tell them, are you filing it, yes or no? It's also alerting the organization to other types of returns or forms it must file, especially things related to payroll and payroll tax reporting. And some of the other questions on this form relate to totally other forms, such as do you have unrelated business activity? And therefore, are you subjected to unrelated business tax? And therefore, and further, did you file an unrelated business tax return, a 990? So let's talk about, and I said I said before it was on page 4 and 5, but basically on page 4, it's all the way on the bottom. It's just a small section. Most of this information is on page 5. So let's talk about a couple of these things. I think this is pretty good, except the fact that it's not prepared properly many of the times. But right on line 1 on the bottom of page 4, it asks you how many 1099s did you have to file it, and how many did you file? And the top of page 5 asks you the question about W-2s. The reason that this question was added, the reason that this question was added is that in the past, the IRS basically didn't know how many employees were working for the organization, especially if the organization wasn't on a calendar year. That's the area that trips up a lot of fiscal year operating organizations. And the 1099s are if you're paying for service and the person you're paying is not an employee, and you're paying over $600, you're supposed to, according to the rules, issue them a 1099 statement. Now they changed the name and number to 1099-NEC, non-employee compensation. And this information wasn't available. And the IRS really couldn't confirm really whether you were paying people properly and wasn't protecting employees. So now it added this to confirm. Here's the problem. It's asking for information because you don't file W-2s and W-3s and 1099s and 1096s until the end of the calendar year. If you're on a fiscal year, you don't file it at the end of your fiscal year. You file at the end of the calendar year, which is within your year. So that trips up a lot of organizations when asked, how many W-2s, how many 1099s did you prepare? Many times they're thinking about the current year or the year their fiscal year is ending, and they said, well, we haven't prepared them yet, or the number is X. And they have to be told or reminded it's the last year ending in December 31st of the prior year. And obviously this is done so the IRS can match up, and they do this electronically with the numbers that you said, are the W-2s and 1099s, and the number that are reported when the W-2s or 1099s are submitted. Now we're up to page 6. There are 12 pages, and there's a lot of information on this return, as many of you know who've looked at 990s or have reviewed them. So I can only touch on some of these things within the 2 hours, but we're only pretty much halfway through the form. On page 6 is an interesting page because it really doesn't contain numbers. And this is where a lot of organizations also get tripped up. The rules state that every not-for-profit must complete this, as opposed to on other pages, only if you're a 501c3 or 501c4 or a 501c6 membership organization. This page has 3 major sections: a governing body and management section, a policy section, and a disclosure section. The reason that I say this is a problem is because, 1, it's not readily available. 2, there is really nothing in the tax code, which is where the not-for-profit falls under, the 501c code, that requires this information. The IRS took it upon themselves to say this information is important in order to ensure that the organization is complying with its mandate and it's reporting things properly. So it asked a couple of things, a couple of major things. In the governing body section A, um, it talks about the group of people. It says group of persons authorized under the state law to make governance decisions, and it's asking, what are the number of people that are authorized to make these governance decisions? It's basically the board of directors. If there's an older organization, they might use the term, which is a little bit of an older term, board of trustees, which is what board members are. They're trustees. Um, or it could be shareholders or members, but it asks for that question. The second section, the middle section, talks about internal policies, which I'm going to give you some details in a second. And the third section is how do you make some very important information available to the public? Not that you have to, but how do you do it? We're telling you you're supposed to do it. Now, how do you do it? So go to the first section, which I labeled 1A. Well, I have 1A, 1B, and 2 under the section A. We'll talk about the first one on 1A. It asks what are the number of voting members of the board of directors, not the number of board of directors members, the number of voting board of directors. Uh, this this is an area that trips people up because they don't always know who's a legal voting member. They should, but when they're new, they might not know this, even though it's in their bylaws or should be in their bylaws. Typically, in states where an executive director is not a legal officer, it should exclude that. So the number of voting members should be less than the total number of board members. You shouldn't be a voting member. If you are a voting member, and let me explain why that. The board is supposed to oversee the organization's operations and supposed to vote on things. If a person is basically working for the organization and an executive director is a highest staff member, they can't be voting on their own. They shouldn't be voting on their own type of activities. So that's why the organization says, okay, we're going to go for, I'm sorry, the 990 says, okay, we want to know, the voting number of members, how many people can vote on things. And then if you are an executive director and you are voting, which many times they just will exclude, then how many board members are independent voting members? This made it very clear that if you fell into a category that impinged your independence, you are now going to be, you might be a voting member, but you're not an independent voting member. To be independent, three things must exist. You must not get compensated as an officer or an employee from your organization or a related organization. The only exception to that is um, basically if you are on the board and you get paid as a board member, that does not impinge your um, uh, doesn't impinge your independence here. You can get paid for being, but most not-for-profits don't, especially public charities, don't pay their board members. But if they're paying them for being a board member, it wouldn't exclude you. But if you basically get paid, you're not independent. If you're an independent contractor and you're on the board and you got paid more than 10,000, that had impinged you. However, you got reimbursed for laying out expenses, then that didn't impinge you. This applies to you and your family members. So if there's transactions between your family members in the organization, that will impinge your independence. And so that's all on line 1A, line and line 1A and 1B, or at least I'm indicating it. On line 2, they ask you any director, officer, or key employee. Key employee is somebody that has a lot of authority and makes over 150,000. any director, officer, or key employee have a business relationship with the organization. It's pretty obvious what the IRS is looking for here, to see if there's some kind of thing going on that might be untowardry. Now, in my experience, getting down to my issue and errors and tips, um, many times the total number here confuses people. They don't understand what a independent person is, or what a voting person is versus the non-voting. Many times you have people on the board that I have an organization that has it's a um, international organization, and it has many of the presidents and former presidents on the board. Obviously, they're not going to come to board meetings and they're not going to participate. They're on the board, but they're not a voting board member. So that's an example. Um, so the number gets confusing. Sometimes you're president of the board, you're also president of the organization, you're paid a salary. Now, are you independent? Are you, are you considered one of these numbers? If you get paid, not as a board member, if you get paid for performing services, you are not independent. Very clear. And this is a very clear rule. A problem I see is many organizations don't want to disclose relationships. The reason fall into two major categories. One is there's something going on, hanky panky, and they don't want anybody to know about it. Fortunately, my experience, that's the minority of cases. Most organizations are up and up. Other times, it just doesn't want anybody to know that the executive director is related to the chief information officer, because the chief information officer happens to be the son or daughter of the executive director. And since they have two different last names, nobody would know about it, and they don't want to disclose it on this form. Well, they're supposed to. This page, or I should say these pages 7 and 8, which talk about compensation, are one of the more sticky areas of the form. When it comes to salary, it's human nature not to want people to know what you're making, especially the whole world. This information is public. And in the example I gave earlier during my seminar back in 2009, I had, I think he was the executive director, saying, I don't want, everybody to know what I'm getting paid. Not that I'm getting overpaid. It's nobody's business. And I explained to him, and I had the IRS person, Stephen, there reaffirm it's not optional. It's actually required that you disclose this. And again, the reason for this information is to make sure the organization gets all these tax benefits. Both the IRS and I would probably say every state wants to make sure that somebody is not making money that they should not be making, excessive compensation on an organization that has an exempt purpose, and people are making donations and they're not paying taxes on their net income. So they do ask a lot of information. They ask information about every current and former director, officer, and trustee or board member, and every key employee. And then they ask for the 5 highest compensated employees. We'll explain that in a minute. What's a key employee, highly compensated employee, and your 5 highest independent contractors. Again, you have to disclose compensation from your organization, this organization, and from related organizations. Now, what's related? You have to look at definitions. The IRS considers parent companies. You're a subsidiary, and so they're a parent, they're related, or you have a subsidiary, a for-profit organization. That's where problems come in, because you have a subsidiary 100% wholly owned, and people are getting paid. and you must report that. And if you have a related organization, which is not parent child, but basically brother sister, where you're both two organizations are working out of one office with similar staff and similar board members, I call them brother and sister, they're related, you must talk about this. If you are over certain thresholds, basically over 150,000, you then have to provide more information on one of the schedules, Schedule J, in addition to what you put on this Part 7 on this page 7. So here are some definitions. Current director, officer, or trustee. By the way, I use the acronym a little different than the IRS because it sounded a little better. DOTKey. When I'm talking, it's similar to Donkey, DOTKey, directors, officers, trustees, and key employees. And I use the term, the acronym HICE, highly compensated employees, to talk about that because it's easier on abbreviation. So if I mention that, you should know what it is. The current directors, officers, and trustees, you must report any compensation. There is no threshold if they served at any time during the year. I want to repeat that. They served during any time of your operating year, which could be a calendar year or a fiscal year. Here is an area that's done incorrectly a large percentage of time. I can't tell you what that percentage is, but a large percentage, maybe 20, 30% of the time, maybe 40% of the time. If you don't read the instructions, which again, a normal person, unless they're a masochist, wouldn't really want to do, but if you don't read it, you wouldn't know that an executive director, which is clearly not an officer in many states, for this section and this section only, the rules state that you must be treated as an officer for reporting purposes. So let me repeat that. For reporting on this schedule, which is the part 7 on page 7 and 8, if you're an executive director, you get treated as an officer for reporting purposes, even though you're not a legal officer. The chief financial officer, whatever title you want to call that person, controller, chief financial officer, the highest financial position person must also be considered an officer for reporting for this section and this section only. And I could tell you it's just not done. So they have to be reported on here, regardless of their compensation level. Then the highest compensated employee, the 5 highest, I should say, if you make 100,000 or more, you get reported here. And if you're a key employee, which means that you hold a responsible position and you make 150 or more, they want you to report the 20 highest key employees on this form. Now, here's the tricky part. The directors, officers, and trustees must report based on any point during the year. The key employees and highly compensated employees must report only if they meet the test on a calendar year, not on the fiscal year. This is a very confusing area for a lot of people. And this is, the IRS decided that officers and board members, they wanted them reported regardless. They wanted to match the books to the return. But with other positions, they said only if we could tie to the W-2, which is a calendar year. Let me bring it home and give you an example here. And add one more piece. There was a recent change beginning in 2019. The IRS said, well, let me tell you what the old rules were before the new rules. The old rules were you were supposed to list the compensation in the order of board first, board members first, officers second, key employees third, highly compensated employees fourth. They changed the rule beginning 2019, and they say now you must put the highest compensation, the person who received the highest compensation first in that order and go down to the lowest. That means in most cases, the directors or officers who don't get paid, or definitely the board members of many organizations, would be at the bottom, not at the top. Again, you must include all officers and directors on this list, even if they don't receive compensation. Because again, it said anytime during the year if they were an officer or a director. And many times the problem is that they are not included. And many times the executive director is not there, and many times the top financial officer is not there. The tricky part is if it says on a calendar year and you have to go back and decide, did they meet the tests? It's very confusing. So I'm going to repeat this again because this is a contentious area. So if you're a director, officer, or trustee, you should be on this form if you were a director, officer, or trustee at any point during the year. If you're a key employee and you meet that test, or you're a highly compensated employee, highest, anytime during the calendar year, not necessarily during your fiscal year. So if you're not confused enough, guys, I will give you an example and then I will move on. Let's say you're on a fiscal year ending June 30th. Okay, and that's at the end of year 2. I'll use me as an example. Okay, I started working on January of that year. Okay, but it's a fiscal year, so I'm started in really at the second half of the year, and my salary was $120,000. Okay, if I was a key employee or highly compensated employee, I would not be on this list because it must match the calendar year, as I said here. However, and this will make the rest of you confused. So if I didn't lose you throughout the seminar yet, I might lose you now. If I'm a director, officer, or trustee, I'm the treasurer of the organization. I started on January of the second half of the year. I get put on the schedule because I was on during any part of the year, but because I didn't get any payment as of the end of the year, last year, I didn't get a W-2. I must put 0 in the boxes because the form says right on column D, reportable compensation on the W-2. That is very confusing. And I could tell you there was one client I remember years ago that the executive director got a bonus, and it wasn't their usual salary. And the bonus was really more of a catch-up amount of money based on not having the money in the past and not getting paid their usual salary. So they kind of deferred it. And this one year they had a little bit more money and they paid the executive director the usual compensation, which was lower than the agreed upon, plus a little catch up. And that executive director did not want to report what was on the W-2 because it wasn't the lower amount that they'd been paid. And no matter how it was explained to them that it must match that number, they just didn't like it. So this does cause a lot of contention. Moving on to this page 9, this is one of the pages that have the least confusion or the least amount of questions. Basically, it's putting down, it's the statement of revenue where your income comes in, and it's basically grouped in 3 groups: contributions, gifts, grants, similar amounts, program service revenue, and other revenue. But what makes it different than other types of returns, it's pretty delineated. It's broken up into a lot of detail about where the source of your revenue is coming from. All organizations must put total amounts, and certain organizations, with the exception of political organizations, must fill out some of the other columns about unrelated business income. There's a couple of tricky things, but I'll leave that out, which fall under section 512 and 514. This is done incorrectly. Like if you raise money on fundraising events, they get put here, and a lot of people don't know what to do with that. However, the form is pretty straightforward and everybody understands it, but they don't understand the implication of putting numbers in the right place when it comes to related expenses. What I mean about that, there's a couple of sections here that I will highlight. One of the sections, and you could follow with the color coordinating 1 to 1, 2 to 2, 3 to 3. Section 1, rental income, talks about rental income less your rental expenses. Section 2, your investment or stock investments, other than inventory, bonds and stocks that are sold less the cost of those stocks and bonds. Fundraising income, you do a fundraising event, less direct expenses related to the fundraising. Section 4, income from bingo or other games, that it doesn't come up so much, less the direct cost. Sale inventory, your organization is a clothing, you give out clothing or you sell clothing. You get your Salvation Army gets donated clothing and furniture. Some of it you buy, a lot of it gets donated. The cost of that inventory. The problem here is many times the cost that I just talked about, the cost of the stock, the cost of the rental, is not put here. Instead, it's put with the other expenses, which most people understand it's an expense. So we put it with expenses. There is a big problem with putting the expenses with the other expenses and not putting it as a subtraction to the revenue. The reason that it's a problem is because many times the adjusted gross revenue is used as a threshold for certain types of reporting. That is one big problem. An example is in New York, which I'm most familiar, New York, New Jersey, California, and some other states. In New York, if you raise over a certain amount of revenue, for example, if you raise over $1 million, it was adjusted to $1,084,000. If you raise that, you must have a audit performed by an independent auditor, a CPA, a financial audit. Now, a lot of organizations don't realize this. When they say your gross income, it's not really accurate to say gross income, which most people means gross, not with any adjustments. It really should say adjusted gross, but I guess they felt a lot of people didn't know what that meant, because that will determine. And if you don't put the reduction of your cost of fundraising activities or stock sales, one year you sold a lot of stock, you will be over that threshold, and you will say, I now need a financial audit performed. In the case of New York or New Jersey, $500,000. California, I believe it's 2 million, unless it was adjusted recently. So they use the number on this form to determine whether you need to have that audit. And in some states like New York, if you're under it, you might need what's called a financial review. So putting your related expenses on this form is very, very important if you are coming close to those thresholds. Statement of functional expenses or statement of expenses is where you put down your expenses. It is a two-dimensional form. It reports expenses by program, by your programs, and by supporting services, and supporting services being management in general and fundraising. It's two-dimensional. Unfortunately, a lot of organizations, especially new ones or smaller ones, don't maintain their books in a two-dimensional way. and have to manipulate the numbers at year end, not for a bad reason, but combine them and in such a way that they can combine and have all expenses related to programs, management, general, and fundraising for reporting purposes. Um, just to hold in a couple of things. Um, if the organization does not put down any fundraising expenses, we don't incur any fundraising expenses. Everything we get is directly to the program. That is a flag, especially if you're raising grants, raising contributions and grants. The reason is, in almost every case, time and energy and resources are being used to raise money. And while the organization doesn't think it's incurring any expenses, it is incurring expenses, even if it's simply an allocation of the executive director or president's time to run around and solicit contributions and grants, or to fill out grant applications. So there should be done, at the very least, there should be some allocation of that person's salary to fundraising. I've seen cases where organizations have allocated all of their expenses to their programs. One funny time is the controller made a mistake arithmetically. He allocated so much of salaries of everybody to the program. He actually had a negative salary in management in general. It was just a mathematical error. It was pretty funny, and of course we caught it. But it does show the desire to want to say every one of our expenses, everything we spend, goes to our program. And there is a big push to tell the world that we're spending all our money to do what we were given an exemption to do, and not spending anything on overhead. But you should be somewhat reasonable in reporting here. The next page is not really too big of a problem. It's your balance sheet. Statement of financial position for not-for-profits. If you have 2 years, it's not a problem. If it's your first year or your last year, it could be a problem. Only that you should be putting down 0 in the if you're well, if it's in the middle of the year. But if it's your first year, you're not going to have a prior year. So you have to that's where you have to put the 0. Not so much your ending year, but that's just not done. A problem is, especially if you're not using tax software or return software, is that these numbers on here don't agree with some of the other numbers on the other pages. If you mail it in, send it into the IRS, hard copy, it's not going to get caught. If you're using software, it's going to check this and give you a diagnostic. The last page is only really a half a page. It reconciles your books to your return. And why shouldn't your books and your return be exactly the same thing? Well, the IRS has decided a couple of things are not necessary for reporting purposes. They don't want you to report unrealized gains and losses on your stock. Under accounting rules, generally accepted accounting rules, GAAP, you're supposed to adjust your stocks and bonds, your traded securities, to the fair value each year, even if you don't sell it. And that is classified as unrealized gains or losses for financial statement purposes. On the 990, that is not considered a revenue or an expense. And therefore, to reconcile your financial statement, especially if you're submitting it with the attaching it to the 990 for state reporting purposes, you need to have a reconciliation. That's one of the things that is that'll be not on the return, that'll be on your books. Another big category is donated services and facilities. Certain professional services under general accepted accounting principles are picked up on your financial statement. If somebody is donating, if they're an attorney or an accountant or a nurse or another professional, if they're donating the time, you pick it up. For 990 purposes, reporting purposes, it's not picked up. So there's going to be a reconciling number, and that's what gets put on this section. Other things on the bottom, it asks you, were you audited? And was the audit done on a separate audit, meaning just for your organization? Or were you and a parent or subsidiary or brother and sister consolidated? And you're telling it yes here, yes or no. We have about 12 minutes left. I said there are 16 schedules. On any one of these schedules, I could easily spend a half an hour or more. Obviously, you won't have that time. There's a lot of information to cover. I'm going to only talk about two of the more prevalent schedules that are used. But again, every one of these schedules are required if they apply in the organization's case, or if the organization is a certain type of not-for-profit. If it's a school, it must complete Schedule E. If it's a hospital, Schedule H. Sorry. So I'm only going to talk about a couple of these. I said highlighted in red. Originally, I thought I'd have time to cover more, but unfortunately, we don't. Schedule A, which all public charities must complete, is a very important schedule. It's very important because it will determine whether you continue to be a public charity, meaning if you continue to meet the tests. In order to determine whether you meet the test, the IRS wants to know, did you meet your test for exemption? Are you getting most of your money in the form of contributions from the public? You know, a misconception a lot of people have, even in regulatory agencies, is that if I ask a general population, what does the term public charity means? Most people would say a public charity is an organization that does something for the public and does good for the public, has a benevolent purpose. And that's not wrong. That is one of the elements. But for the Form 990 and for reporting purposes, to be eligible to be quote unquote a public charity, you are saying that you're receiving the majority of your funds, which I will define shortly, from the public. That's what defines the public portion of that word, public charity. So to meet that, you have to show the IRS that you received most of your revenue from the public. And there are tests that you must do on this form. The IRS gave new not-for-profits a break. They said, if it's your first 5 years, we're going to assume you meet the tests, and we're going to give you a break. We're going to give you the benefit of the doubt. So we're not going to make you fill out any of this detailed information. Some you have to do, but not the numbers that determine whether you met your test. Now, after the 5th year, going into the 6th and 7th year, you don't meet the test. By the 7th year, you're going to lose your exemption. When you ask a general statement, how many types of not-for-profits there are, many people would say, you know, there are many. But even within the designation of a 501c3 designation, there are subsections of that which fall under IRS rules and therefore IRS reporting. The part 1 of Schedule A, you check off the box that you got your original determination. This one that I marked off on line 7 is your what I consider the highest charitable level, which is 33 1/3 of the public of your support comes from the general public. If you check this off, you must complete the next page. Here's the problem with this form. In order to do the next page, you must track contributions by individuals, especially if they're large contributors, which you don't generally do in your general ledger. In the general ledger, you put all your revenue into contribution account. but you must maintain it individually on Excel or separate software, because you need to report on this form. We're running kind of out of time, which I was afraid would happen, and I want to leave a little time for questions. I'm going to ask the people monitoring whether we can go over the 2 hours for questions, in which case I will go right to the end with my presentation. Otherwise, I'll stop a minute or two before.
We can go through. We can go through a few minutes after. I'm imagining at the 5 o'clock mark, though, people might have other places to be as well. So those who have questions can stick around, and we can record those.
Okay, understood. So I will try to sum this up. I apologize for the fact that this is a very confusing area and could take 15 minutes to explain the calculation. But in summary, what they want to do is, what the IRS wants, they want to find out is any single contributor, excluding not-for-profits and government, any individual corporation or foundation, are they giving more than 2% of the total support over 5 years to the organization? And the reason for this is they total the number of donors who give 2% of more of the total support over 5 years. They total that. And if that number becomes a tipping point to the organization, meaning that now the organization is getting what they consider most of their money from a very few number of donors, then the IRS is going to reclassify this organization from a public charity to a private foundation. A private foundation is in many ways is very similar to a public charity, with the exception that they might have investments and pay excise taxes, but they can basically get tax deductible contributions, and they don't pay taxes on their net income, with the exception of excise tax as being one of the big exceptions. So a private foundation is pretty similar. The only big difference is a private foundation is financed, supported by a few number of donors, as opposed to a public charity that's supported by a large number of donors. And that's what this schedule does. It pulls out. On the next page, and I could go through, if I had time, I'd go through this. I give an example of pulling out the excess contributions from a number of organizations. And what that does, it dilutes the public support test. And it goes from 100% down, in this case, 2 years ago, to 89%, and last year to 71.75%, by pulling out major donors over the last 5 years. And again, this must be tracked individually. I'm gonna end with Schedule B, which asks that all major donors that give either one or two things, $5,000 or more, and this includes government too, $5,000 or more, or if you're a public charity, it will use a different test. So just to go here, it wants you to talk about disclose $5,000 or more that you received from any organization. There's special, that's a general rule, by the way. Special rules go if you're a public charity or a Section C, 7, 8, or 10 organization, and you meet the test for 33 and a third support test, you only have to report greater than the 5,000 or 2% of the total donations that year. Example I gave is you have an organization that has total donations of $2.5 million, and a donor gave $40,000. Well, that 40 is over the 5,000 threshold, but because of the special rules, the 2% would be 50,000. The 40,000 is under. You don't have to report. And I'll just end this my presentation, and then I'll take questions. Schedule O. It is a line pad that either has continuing information that doesn't have room on the form, like your mission or your program service activities. It'll roll over, hunt over here, or it answers questions that there's no other place to answer. The proper heading and the order is you do your answer is based on the 990 part, page 1 through 12, then the line, and then the column, or then after that, the schedule. The only thing I'm going to mention here, which comes up periodically, I mentioned doing an initial return and then filing an amended return. The 990 does not have a 990X. There is no amended return. There is a 1040X, but there's no 990X. So if you're filing an amended return, what do? Well, you check off the box on page 1 that says we're doing an amended return. You change all the numbers or answers that are now appropriate. And on Schedule O, you're supposed to put down what your original numbers were. Now, the instructions are very vague. They don't say how you're supposed to put the original numbers down. I mean, you can't put 12 pages of changes down. So I suggest putting major sections: total assets, total liability, the original one, total revenue, total expense here, if you're doing an amended.
Nice finish line there. Thank you so much, Larry. We have some questions in the chat. I don't know if you just want to look them over yourself, or
why don't you read it, because you could be well, I guess.
Sure. Well, what there's a question coming up, and I don't know if you just answered it in the last slide, because I don't know if the schedules are the same, but someone asked about my screen just changed.
I'm going to the chat. Let's see, so I can read it. Revenue goes up and down. We answered that. Can they switch? So I'll try reading it. Let me do it.
Well, I can just tell you there's two right there right now. One is, where do I find the total amount received in donations in a 990 PF, which I don't know if it's the same schedules that go along with the PF as the regular 990, or.
The answer to that is the 990 PF is a totally different return. It's not geared to reporting all contributions received in. I don't know off the top of my head what place you put that. There is a line for it. I'm going to guess, I'm just trying to do this from memory, whether there is even details on that, but it's a totally different form.
Great, that's helpful, I think. And then another question is, from a CPA's perspective, is it legitimate for an org to allocate $0 to fundraising expenses because a private foundation or some other type of organization is performing and or paying for all fundraising services? How often do you see this?
I don't see it that often. It is appropriate if it's accurate. And I'm going to repeat that question, that answer. It's appropriate if it's accurate. If really you have no cost, it's handled outside. You have, remember, if you have an outside contractor doing it, that is what's being paid. If I hire somebody as a fundraiser, then that expense would go in there. So if somebody's doing this, then and it's totally being done outside, then it's zero. But many times that's not the case.
Great, thank you. And then one more question is, with the new requirements to file electronically, are there any sites or services where this can be done for free of costs?
The 990, the IRS used to use an outside service. You now can file the 990 directly with the IRS. They let you do it electronically without. They changed from years ago having an outside service, so you can do it online. The problem with that is doing it through them. I don't know if you have the benefit of diagnostics and checking. They have some checking, which means certain things will fall through if you're not using either a preparer or using software. Let's see. I see a couple other things. Just to be sure, all nonprofit corporations must file 990 regardless if no donations were received. What if the organizations uses fiscal agent? We covered that already.
I think we've covered all the ones in the chat,
Oh.
but I'm curious if anyone who's here still has questions remaining. I mean, it was a jam-packed 2 hours, and there was so much to learn, and the fact that this many people stayed the whole time and are probably furiously taking notes and have asked for your slides
Okay.
says something, right? So I'm wondering if anyone in the audience right now has any questions they want to unmute themselves and just ask them, or anyone?
Would we be able to get the slides?
Moisha, yes, I will. I will print out a PDF. I will send it to Christina, and she can probably she'll upload it somewhere. You can get it.
Sure, I'll put these on the
Okay,
Center for
that would be
Nonprofit.
appreciated.
Yeah, I'll put it on their website with the video, with the link to the video of this talk. So
Okay,
yeah.
and then you'll send us an email on it.
Absolutely. And with the
Thank you so
evaluation,
much.
which I also put in the chat. So if you can either do the
Okay.
evaluation now or when you get the email.
Please, thank you.
Any other questions?
Cool.
Thank you so much. This was amazing. I feel like this is such a service for the nonprofits that are really trying to figure out heads from tails from it. And you know, as someone who has studied the 990 as a researcher, it's no easy feat, right? I understand it's no easy feat. So thank you so much. I want to thank Larry once again for coming to Consulting Days. This is actually the last event of the week, so we really appreciate your time, and we appreciate all of you coming to this session. I hope it was helpful. That's kind of the goal of the center, is to be helpful. And look for an email in the next week with the link to the video and the slides and the evaluation. I also want to thank Maria Rodriguez, who's on the phone right now, who is our administrative everything right now at the center. And she has really been a one-woman show just about putting on all of these webinars for and linking clients with consultants in the past 2 weeks. So thank you so much, Maria. I appreciate it. And other than that, have a lovely rest of the day. The sun is starting to shine in Brooklyn right now, so I hope you all can get outside.
You're very welcome, and I'll be talking to Christina.
Thank you. Yes.